Your emergency fund target may be too low, not because the old rule was stupid, because the economy changed around it. For years, people heard the same advice: save 3 to 6 months of expenses. That sounds responsible, and for some people, it still is. But right now, the latest personal saving rate is only 2.6%. Inflation is still running at 3.8% year over year. Rates are still high, and household debt is sitting near record territory. That means the same emergency fund buys less time than it used to. So the real question is not, do you have 3 months saved? The real question is, how long could your household survive without making the problem worse? This is educational content. It is not financial, legal, tax, or investment advice. The 3-month emergency fund rule is useful because it gives people a starting point. But a starting point is not the same thing as a target. 3 months of expenses for one person can be strong. 3 months for another person can be fragile. It depends on the life behind the number. Do you have one income or two? Do you rent or own? Do you have kids? Do you have medical costs? Do you carry credit card debt? Could you replace your income quickly? Those questions matter more than the rule. Because an emergency fund is not a trophy. It is runway. It is the amount of time you can buy before a bad month becomes a debt spiral. That is why the target has to match the risk, not the slogan. Here is the part people miss. Inflation does not just make life more expensive, it makes your old emergency fund less powerful. If your monthly baseline used to be $4,000, then a $12,000 emergency fund looked like 3 months. But if your real baseline is now $4,700, that same $12,000 is no longer 3 months. It is closer to 2.5. Nothing changed in the bank account, but the runway got shorter. That is the danger. People see the same savings balance and think they are equally protected. But protection is not measured by the balance. Protection is measured by how many months that balance can actually cover at today's prices. Your emergency fund has to be repriced just like your budget. Emergency funds get weaker when debt payments are high, because debt does not pause just because life gets messy. Credit cards still charge interest. Auto loans still want payments. Student loans still sit there. Personal loans still pull from the same cash flow. And when rates are high, the penalty for carrying expensive debt gets sharper. This is why two people with the same emergency fund can be in completely different positions. One person has $10,000 saved and no high-rate debt. Another person has $10,000 saved and $600 a month in credit card minimums. Those are not the same safety net. The second person has a leak in the bucket. So when you calculate your emergency fund, do not only count food, rent, and utilities. Count the obligations that keep coming even when income stops. That is your real monthly survival number. Here is a better way to think about it. Your emergency fund target should be based on risk, not vibes. Start with your baseline expenses. That is housing, food, utilities, insurance, transportation, minimum debt payments, and basic health costs. Then look at your income risk. If you have two stable incomes, your runway requirement may be lower. If your household depends on one paycheck, the target should probably be higher. If your income is commission-based, freelance, seasonal, or tied to a fragile industry, higher again. Then look at replacement time. How long would it realistically take to replace your income if it disappeared? Not in a perfect world, in this job market, in your industry, with your skills. Then add household complexity, kids, medical needs, older family members, a car you must keep running, a mortgage you cannot miss. Every complexity adds pressure. That does not mean everyone needs 12 months of cash, but it does mean 3 months is not automatically enough. Here's the simple framework. If your life is low risk, 3 months can be a reasonable base. Low risk means stable income, low debt, low fixed costs, no dependents, and quick job replacement. If your life is medium risk, aim closer to 6 months. Medium risk means one primary income, some debt, higher fixed costs, dependents, or a job search that could take time. If your life is high risk, think in terms of 9 to 12 months. High risk means variable income, high debt, health concerns, dependence, unstable industry, or a household that cannot easily absorb income loss. The point is not fear. The point is honesty. You are not building an emergency fund because you expect disaster every week. You are building it so one emergency does not force you into bad debt at the worst possible time. Here is the move for this week. Calculate your emergency runway. Take your emergency fund balance. Divide it by your real monthly baseline. Not your ideal budget, not your old budget, your real baseline right now. If the number says 2.4 months, do not call it 3. Call it 2.4. Reality is useful. Then decide your target based on your risk tier. Low risk, 3 months minimum. Medium risk, 6 months. High risk, 9 to 12. And if that number feels huge, do not panic. Build it in layers. First, $1,000, then 1 month, then 3, then the full target. The goal is not perfection next week. The goal is to stop pretending the old number is enough if your life got more expensive. Your emergency fund is not just cash. It is time. It is options. It is the ability to make calm decisions when life gets loud. And in a world where prices are higher, savings are thin, rates are elevated, and debt is expensive, the old target may not protect you the way you think. So update the number. Measure your real runway. Build the cushion in layers. And make sure your emergency fund matches your actual life. Subscribe for more practical money strategy, financial literacy, and real-world wealth building breakdowns. And I will see you in the next one.